Our next guest, upgrading the stock to overweight from equal weight and upping his price target to $95 from $65. Joining us now is Wells Fargo's Andrew Bauch. Andrew, give us a sense of kind of what you saw here that was strong enough to up your price target that much, as well as upgrade your weighting here.
Yeah, just to give you a little bit of a context, like we haven't really been constructive on Block for about 2 years now, but this is the second straight quarter where they've delivered like really impressive results. And broadly speaking, they've gotten their act together. I mean, the things that they've been doing around the cost discipline side of the story, another strong 4Q, the Cash App monetization story continues to be on track. And, the company is taking a much more, prudent approach to how it thinks about the margins in the longer term, and it really acknowledging stock-based comp as a real economic cost. With the growth algorithm kind of in place for 2024 and seeming like how they gave the guidance that left room to the upside, we think that the risk for the reward is finally in a place where bulls can get excited.
What do you make of kind of the portfolio of businesses? Because if you read through kind of the commentary from these earnings, it feels more like the traditional Square point of sale business is now just a footnote, basically, in the company's growth strategy. I know that's not true, but it just kind of feels that way. Do you kind of like the way that they're focusing this kind of repositioning of the business?
Yeah, I mean, it's a tale of two stories, right? Cash App is the number one leader in digital wallets and neobanking, especially among Gen Zers. The Square side of the story, I think, admittedly by them, has taken a step back over the last couple of years, and they did have a leading market position before we entered the pandemic. But when you saw all that rapid growth from Cash App, that's kind of where they put their investment dollars behind. Now, based on our channel checks and our industry research, we think that the gap between the leaders and the pace setters in the physical point of sale space is not insurmountable. Now, it will take some time to kind of re-verticalize the sales teams, get a local boots on the ground approach for go-to-market. But ultimately, we kind of lean into management's track record of really impressive innovation in the space and wouldn't put it past them if they close that gap within the next year or so. So both engines of the story are important for longer-term growth. You could argue that Cash App is the upside driver and seller kind of sets the floor, but we like that balance.
Would a Capital One Discover merger, if that were to go through, have any bearing on Block itself, just given kind of it makes for a bigger deposit-taking institution, kind of alters the payments universe a little bit?
Maybe on the fringes, but neither of those companies are really focused on Cash App's underbanked target markets and really doesn't have the virality in the marketplace that a Cash App does today. I think that, if you look at what Cash App's actual drivers are, they're really kind of internal. They have 56 million active users, but only 2 million of those users are direct deposit paycheck users. And, there's a lot of an 80-20 rule that's kind of applied in fintech and payments that your most monetizable users are smallest piece of your base. So really just expanding that direct deposit base is really what they need to do to kind of make the model work. And I don't think that's going to be impeded by Capital One or Discover and really other M&A in the space.
Hey, finally, Andrew, just more of a macro question. A couple of weeks ago, I did see a note from Morgan Stanley. We don't want to make a mountain out of a molehill, but buy now, pay later is on the rise and bears watching. This was a comment on basically household balance sheet health. Is it something that is worth monitoring?
I mean, it's worth monitoring, but I think that there's still a great misunderstanding on how the credit mechanism works for these buy now, pay later companies, named like Affirm and which we also cover. Like their duration of these loans are very short, 3 to 4 months, even how the book turns around. And plus, a lot of these loans have direct, pulling funds out of your bank account. So there's not as much of the stacking credit risk as a lot of investors like to assume. In addition, also, these companies make underwriting decisions on a real-time transaction level basis. That's far different than, a young kid going into the mall and taking out a store credit card for, just a flat balance that they can immediately and inevitably run up.